Hey, welcome back everybody. Another quick update from us, this time about our 10x weekly crypto kickoff report. Every Monday we send this report out. We highlight everything from volumes, open interest rate changes, sentiment, some technicals, the derivatives markets, and potentially a way how to trade this market from here onwards. So of course, the crypto market itself has lost 1.3 trillion US dollars, almost 1.4 trillion. We peaked out at 4.29 trillion, and currently we are trading at 2.9 trillion as a market cap for the overall ecosystem. Of course, this has been around 31% of the crypto market has been really lost. Volumes have actually been relatively muted. We peaked out at 394 billion, and over the weekend we just saw around 117 billion, so which is of course not a lot. And even during this recent decline, the largest volume increase was only 262 billion US dollars, which is significantly less, of course, during previous liquidations, during previous market crashes. But I think it shows actually that the futures market has been active while the spot market has actually been relatively muted. We have not seen a lot of unwinding from altcoins despite some of the correction. Of course, Bitcoin open interest has declined significantly by around 15 billion. We peaked out around 45 billion right at the October 10th crash when Trump announced, of course, the potential 100% tariffs, and we had the huge liquidations. Since then, the market has reset lower and it didn't really rebound. I think that is really a sign that not a lot of people actually have put on positions. A lot of the futures positions were wiped out, and so far people are actually staying on the sidelines, and that's why potentially this rebound could actually also peter out relatively quickly, because not a lot of money will likely be put back into the crypto market over the next kind of like 2-3 weeks. But then we have, of course, to see what's going to happen in December. But nevertheless, recently the funding rate has finally dropped into negative territory, which is a sign that people are trying to short the market. Arguably, they tried to short the market at really bad levels, and I think that's why those people probably got stopped out very quickly over this weekend ramp up that we saw. And on the terms of liquidations, this was actually the largest or the second largest liquidation move really over the last 18-24 months, really since the launch of the Bitcoin ETFs. Of course, the liquidations that are reported are significantly less than we're seeing actually really happening in the market, and that's because the exchanges have changed how they report the liquidations in 2021. There was some pushback from politicians and from the regulatory side, but nevertheless we can work with this data point, and it indicates really that the second largest liquidations just happened in Bitcoin, but it has not really been a liquidation across the whole crypto market. But nevertheless, the market is significantly less exposed than before, but of course we need more money to come into the market to push prices back up from here. And I think the biggest impact has actually been on Ethereum, where the open interest decline was actually 20 billion, and considering that Bitcoin is much larger than Ethereum, this unwinding of Ethereum open interest is actually really significant, and it also goes in line with the drop in volumes. So volumes were at the peak 122 billion. Currently they are just like 23 billion, so there's $100 billion less traded per day basically in Ethereum right now. So it shows really that people are stepping back, people have stepped back, and this really shows in this continuous decline in open interest that is currently at 15 billion, but at the peak was at 35 billion. So it's a significant decline in open interest, which shows significant decline on a drop in interest really to trade Ethereum right here. And together, Bitcoin and Ethereum perps, open interest has really dropped by more than 28 billion. Just recently. Of course, this is like a little bit adjusted from the last couple of slides, but it really shows that those two really make the bulk of the market, with like 38% drop in open interest from the peak really that we saw in October to now. So it's quite interesting. I think what's really happening, it's really institutions that we believe are unwinding a lot of their exposure. That's why we're seeing really the concentration in those two main cryptocurrencies right here. Bitcoin dominance has also been relatively lackluster. Normally, what we're seeing, of course, in market crashes and market consolidations is that the money will go back to Bitcoin, but not this time. Of course, the dominance increased a little bit, but then it started to fall down. And of course, with the decline in the crypto market cap, it's not really the time to buy altcoins here. That's why our altcoin model, which really looks at the open interest, which looks at the Bitcoin dominance, which looks at the crypto market cap, has been focused on Bitcoin, over the last, I think, almost like 60 days now. So almost for the last 2 months, it has been a preference, and it has had a preference for Bitcoin over altcoins. But because Bitcoin is also trading below the 30-day moving average, it's not really the time to take a lot of exposure. But I think it just shows also really that Bitcoin is failing to attract a lot of the capital that normally rotates out of the altcoin market. And this, I think, is really, I think, shown really in the stablecoin market. When we look at the 1-year rolling change in the minting activity and the market cap of stablecoins, we also have seen a sharp drop. So not a lot of money has suddenly really come into the market. That's what we usually expect. Of course, if markets go down, then money will come in, but not this time. So we're seeing, of course, that USDC Circle stablecoin has had a lot of strong inflow, over the last kind of like 12, 24 months, but this has notably slowed down. It's still, of course, up compared to a year ago, but not as significantly up as it was a month ago. So it really indicates that money is actually not really coming into the crypto market, and that probably also kind of dampens the rally a little bit or the potential rebound. And this is, of course, indicated, in our daily minting impulse indicator, which has actually been negative over the last month. So there was actually some off-ramp occurring. Money is not just coming in, money is actually going out of the crypto market. So that's why the Bitcoin dominance also fails to pick up, because the money just really goes from any crypto coins back into fiat right now. Of course, the outflows are not huge. I think they were around like $800 million. So, but it's still, I think, relatively significant that we're not really seeing that the money stays in the crypto market. And of course, a key indicator here is that the ETFs, notably the Bitcoin ETFs, actually have seen some strong outflows, 3.5 billion US dollars for this month. This is the second largest month, similarly to February. So a lot of outflows are occurring. And I think that indicates that institutional investors have stopped allocating into Bitcoin. And that, I think, has prevented really that this is, this equilibrium between the OG sellers and the buyers, notably the ETF buyers, actually was come out of whack, this balance, and suddenly we saw the sell-off, and it's because really these ETFs have turned into sellers, and as long as they keep selling, I think the market will have really struggling really to stay up here or to rebound, because the ETFs still holding quite significant amount of money that they could potentially unwind. And we're seeing this potential overexposure really through the ETFs, that they have bought $22 billion year to date, while Bitcoin is, of course, down year to date. Also, the futures open interest is just marginally up. Of course, a lot of people were stopped out on October 10th, but nevertheless, the open interest has actually lagged almost like since the April low. And I think it really left the ETFs as the huge buyers of Bitcoin, but because they turned into net sellers, that's why we had this sharp correction. And of course, this has repercussion for the overall crypto market. On a technical level, Bitcoin, as we said already last week, is oversold. We have reached the 33% in the RSI level. Historically, every time we reach this level, there was a rebound. The question is, of course, is this a technical rebound? Are we going to run into resistance? We strongly believe so, and we explained a little bit more in our report. So I would encourage everybody to look at the report, look at some of the resistance level that we have identified, and I think it's going to be very tough for the market to really rebound, because we're not seeing a lot of money coming into the stablecoin market. Plus, we're seeing some ETF outflows that are quite significant. I think the fact is, of course, that we rebounded on Friday was because of the New York Fed President Williams indicating that, of course, there could be still a rate cut in December, so the pricing has moved again in favor of the rate cut. But more significantly is that the Bitcoin ETF saw actually some inflows, and I think that gave people some confidence over the weekend, and I think that's why we rebounded. Similarly, Ethereum is oversold. A reversal is in place. Every time we hit this, below 30% level, the market rebounded. It might not rebound immediately, but I think as we're seeing, there is already some reversal in place, and I think that can last a little bit. But the question is it going to last for just a couple of days or last until the December 10th FOMC meeting? Our own Bitcoin greed and fear index, which is faster than the normal index, has already hit rock bottom, and I think that's why the reversal indicator and the reversal potential was quite elevated already last week. We came out in a previous video report where we indicated that I think it was on Thursday that the reversal would be near. So it was, of course, a day or two before the reversal actually happened. But I think it was quite timely in the sense that, historically, every time the 20-day moving average hit this so lower bound of 10%, that the market tended to rebound eventually. And some of the times the market actually rebounded significantly. This time we think the rebound will not be as enormous, but nevertheless, I think it cuts off a little bit the downside risk here. Overall, Bitcoin implied and volatility has kind of peaked out here potentially. We have, of course, come from the high 30% for Bitcoin into the high 50s now, so almost 60%. So historically, every time this happened, there was a reversal also in the price, because normally we go up in the implied volatility when the market crashes. And of course, for Ethereum, the volatility actually reached 84%, and Friday, just before the US equity open, implied volatility for Ethereum actually reached 100% or 130% even at one point. So there was a lot of panic in the market. People were pricing for a crash. But since, again, the ETF saw positive inflows, we had actually this reversal. And I think that's why implied volatility can actually decline over the next couple of days or even weeks. There has been huge demand, of course, for puts, for the last kind of 5 to 6 weeks already, but this has been increasing and increasing, and I think that's quite interesting. We are really at extreme levels, so people paying really up for puts over calls, and of course, maybe the smart way is really not necessarily to chase the futures here up, but rather to sell volatility, because volatility is quite elevated, especially downside volatility. But what we're seeing, actually, we're seeing quite the contrary here. We're seeing people are chasing upside calls, and especially in Ethereum. So when we look at the last week in terms of the notional that was traded, it was 42%, for example, for Ethereum was in call buying. Not a lot of people are buying puts here. Of course, the puts are priced quite expensively, so this can reverse. But I think we're not seeing a lot of vol sellers, and we're seeing actually still vol buyers, but in the sense of upside calls. But we would actually go the other way. We would think the best way right now is to sell volatility upside calls, and we would sell downside puts, of course, with strict risk limits and risk management. But I think that's kind of the more smarter ways to position ourselves for the next couple of weeks. So thanks for listening. I think when we look at the report, we have a lot more details there. We're indicating some levels where how far we think Bitcoin can rebound. There's two kind of levels we think Bitcoin is going to run into before it might reverse. But again, I think the report has a little bit more details in terms of volatility, in terms of the technicals, in terms of the futures positioning, how perps are positioned right now, what does it really mean, and what are really our favorite trades here. So have a look at the weekly kickoff report. Put a comment in the in the comment section really, and let us know what you think. We're more than happy to keep on producing these weekly reports, because we have so far received great feedback. And thanks for listening, and have a great week ahead.